Why are interest rates for money market funds declining? I'll give an example of Ziidi. It's currently giving us 9.72% net interest after everything. And about a month ago, it was giving us 11%, 12% there, and we were all excited, and that was net. And it's something that you've noticed with other money market funds. In case you have several, you've seen like a slight decline. What is happening to these interest rates should you transfer your money? The answer lies with where the money is. Where the money has been invested in, the interest rates for those investments are also reducing, such that they're causing a trickle-down effect on the interest rates that we're getting on money market funds. Remember, with a money market fund, you are contributing your money to a certain account, to a certain fund. That money is now invested. An example, when you contribute your money to a certain fund, to a certain MMF that you like, the professionals there are going to decide where that money is going to be invested in. And it's usually invested in a portfolio like a treasury bill. So your money, together with other people's money, is going to buy treasury bills. Now, the rates on treasury bills have been declining of the late. Let me show you these numbers. You'll notice that let me choose this one for 364 days. If your money market fund was to buy a treasury bill, a 364-day treasury bill, they were given an interest rate of 10.75%. You can see that interest rate is less compared to the interest rate that was given a week prior to last week, which was 11.29. And when you check for the other week, it was 11.30. So you can see that decline in 11.30 to 11.29. And currently we have 10.75%. And this is just the 364-day treasury bills. What about the other treasury bills? They've also been declining as well. So if your fund manager, your MMF, is going to invest in these treasury bills, in the 91-day treasury bill, in the 182 days treasury bill, and you can see the interest rates are declining, that reduction is going to trickle down to your money because that's where the money actually is. The other place where your fund manager, your MMF, uses your money to invest in is in cash deposits, fixed deposits with banks. So they can decide, okay, we're going to spend this amount of money to buy treasury bills and treasury bonds, and we're also going to use part of your money to invest with banks in form of fixed deposits where they lock the money, and the interest rates that the bank is going to give them is going to influence the interest that you as an investor you're going to receive. Remember, with the money market fund, it's a short-term investment. There are certain restrictions on where this money should go. It's outlined that any money in a money market fund cannot be used to invest in real estate. It cannot be used to buy land or build property. It has to be invested in liquid assets. And treasury bills are one of the most liquid assets, and also cash deposits. When you think about fixed deposits with bank, because that is where your money is, it's just that this time you are investing indirectly, and your money market fund is investing directly on your behalf. What you'll notice is that currently the Central Bank of Kenya has been influencing the rate at which the bank is going to give a return on the savings that are there. The central bank has also been influencing the interest rate that you as a consumer or as somebody who wants to take a loan from the bank. So of late, the central bank has been pushing for banks to reduce their lending rates. And there's usually this rate known as the central bank rate. It's been declining. What is currently happening is that the central bank has been intentionally reducing that rate so that it's easier and cheaper for you who is going to take a loan from the bank so that you can easily access your money. Now that's the whole picture. Now think about it. If the interest rate for a loan is going to reduce, it's also going to affect the interest rate that is on your savings. It is also going to reduce. So a reduction in the loan interest rate, the lending rate, is also going to reduce the savings return rate, savings rate. And remember, your money market fund has invested in those deposits by locking their money with the bank, and the bank is going to use that money to give loans and that kind of thing. And this is going to trickle down to you as an investor. Remember, you're not a direct investor. You're just giving out your money and trusting that money with a professional who's going to be doing that investment for you. You don't have control over this. So those two things have been affecting the interest rate. Another cause is in terms of inflation. Inflation also has an influence on the return that you're going to make from your money market fund account. When we talk about inflation, we're talking about the rate at which you buy goods and services. So there's an increase. It's just that this time the increase is less. When we talk about that, we're talking about a lower inflation rate, and that is what is currently happening. Think about it. Last year, the price of 2 kg flour of maize went as high as to 200 shillings. I remember there was a time like 2 kg of ugali, that is maize flour, was around 200 shillings. And we were thinking about, hey, okay, life is getting expensive. There was even a time where the price for wheat flour was also around 200 and something. You remember that time. But right now, if you were to go to the supermarket, you'd notice that the price for 2 kg flour for ugali, that is maize flour, is around 150 somewhere there, and probably 150 to 170. So it's not that high as it was in the beginning of last year. In such a case, the government would want to increase the inflation rate, that is to increase the demand for goods and services. But the only way it can do that is through the interest rates. So they're going to influence a reduction in the loan rates, the rate at which you go to the bank and take a loan, so that you as an investor, as an SME, you can have access to money to grow your business, to expand your business. What happens as a result? You employ people, so there's more money in people's pockets. And because there's now more money in people's pockets, they want to spend, they want to invest, and money circulates, and the prices for goods and services goes up. So it's the same thing. Back to that story of maize flour. Whatever interest rates that you're going to get from your money market fund account is going to reflect the current economic conditions. The interest rate that we are getting now, of course, is declining, and we are complaining, okay, it's a little bit less, but the value of the money that we have now is higher, because even if we get a lower interest rate, it's reflecting the current conditions where the prices for the goods and services that you are buying right now is also less. The lower interest rate would be enough to help you buy the unga ya ugali because it reflects the current condition. So it's the same thing. If the cost of goods and services goes up, the interest rate that you're going to get, not only from your money market fund account, but also from your treasury bills, from the treasury bonds, is also going to be high. If the cost of goods and services is low, like the case right now, just slightly low, the interest rates will also go down to reflect that, because the value of the money that you're getting now is reflecting the current conditions. So that's the deeper explanation as to why the interest rates are declining.